All right, so let's begin. Multi-asset allocation funds are hybrid funds that must invest a minimum of 10% in at least 3 asset classes. Now, these funds typically have a combination of equity, debt, and one more asset class like gold, real estate, etc. Now, the advantages here that one sees are lesser risk than most of the hybrid funds as the investments are spread across multiple asset classes. Low allocation to stocks means the returns can fall behind in the rising market, suitable for an investor's horizon of that at least 3 years. Also, it's right now the only category that enjoys the benefit of indexation. But is this enough a reason for you to place these funds in your portfolio? Let's discuss more on this. I have with me Dhirendra Kumar, CEO Value Research. Hello, good evening, sir, and welcome to the Money Show. Thank you so much for taking time out. So, a lot has been already discussed about multi-asset allocation funds, but then this is quite a hot topic right now, since most of these AMCs are also coming up with this category funds. Now, if you just get into the nitty-gritties or maybe the basics of this category, multi-asset type of funds have existed earlier also in some or the other way. Talking about their performance, a little more than 10% can be said that's been delivered by these funds, which is almost okayish. The question and concern over here is the benefit of indexation with which the AMCs are also trying to tap in investors. Is this a reason enough for investors to look into these kind of funds? Also, in terms of diversification, where we look at diversification from portfolio point of view, and this is a diversification that a fund is trying to give you. Do you think for better return one can really approach this kind of fund in their portfolio with the tax benefit?
Yeah, it's interesting that, this is the only category left where you derive the benefit of indexation. And if these funds actually, increase their allocation above 65% in equity, it will be treated as equity, which is not too bad because, you have to pay 10% of your gains. But yes, indexation getting, available only for this category is interesting, but that is not the only reason. The real reason why investors are pouring money and more and more companies who don't have one such fund is launching one simply because investors chase performance. 2022 was a good year because, that was the year when equity did surprisingly well. And that was coupled with, gold also doing well. And if 2 of the 3 asset classes do well, and debt was not all that bad because if you look at the debt allocation of these funds, it turned out to be 6-7% yielding investment, and weighted average of that translated into very meaningful about 16-18% return last year, and that is what investors are chasing. Investors' favorite pastime is chasing recent past performance, and this is carrying on. So far, even this year. It's up 14%. So
if an investor is chasing past returns, don't you think any other category, maybe in the hybrid category, any other type of fund would have been a better one?
Yes, but investors can't really understand what is about the when we talk of risk tolerance and relatively more stable asset category, it's not that, investors will be just as happy or unhappy on a day like this when the mid caps are down 3%. These funds will actually withstand these kind of turbulence much better. But on all other days, when you look at the equity returns, they are, eye-popping returns, everything getting close to double digit, getting closer to 20%. That is something when investors will be disappointed because investors want, naive investors want the best of both. They don't want the fall and they want to ride the gains, the upside. And it's a very difficult thing. And here they're able to combine it in some manner. Whatever be the case, whether it be the selling point turns out to be indexation on a 3-year holding period. And during this period, I don't think investors will get disappointed because you end up catching the good part of the cycle. Markets are cyclical. All asset categories are also cyclical. So these funds are able to catch if a fund is able to make sure that it is allocated and keeps its allocation firm.
So that is a very important point to discuss, because when we talk about proper diversification across asset classes, it's also a portfolio approach that one must opt for. After having a well-diversified portfolio, you also have a fund that's providing you diversification depending on the fund manager's capability. Now, what kind of approach do you restrict yourself to? Because you also have to understand at the portfolio level diversification and the fund level diversification in order not to get over-diversified in any of the scenarios, in any of the asset classes. So how can one understand that?
No, my sense is that, the long-term performance of gold may not be very impressive, but so far I have been proved wrong. Also, the fixed income will have its own cyclicality, and it has been very much visible. And most fixed income fund managers also have not been able to anticipate anticipate it well, the rate outlook. When it comes to equity, it is cyclical, and right now we are going through a very dream run. Besides the hiccup, my understanding is, and my advice to investors will be, have your own allocation. Don't worry about these funds. Have your long-term allocation to equity. Have your immediate term consumption needs into fixed income. Have a little bit of, sovereign gold bonds if you have some appetite for gold, just because, you habitually we need to have gold for that reason. And if you look at your whole overall portfolio, there are different ways of looking at allocation. My understanding, I keep insisting that, broadly there are two asset classes you have to worry about: fixed income and equity. Equity gets you growth, fixed income gives you a stability and some return. And if you keep rebalancing it and have a simple rule for allocation, 20%, 25% into equity, 75% into debt, half into equity, half into debt, or, the other extreme, 75% into equity, 25% into debt, you will never be scared and driven out of the market, because it is very difficult to formulate a precise percentage which will make you comfortable. You just need to make sure that you're okay with the madness of the market on unusual occasions, and investors have to manage this allocation themselves.
So, Dhirendra sir, how will you explain the similar role of a fund manager for a multi-asset allocation fund? When you talk about equity exposure, debt exposure, although it's very restricted, but then how do they play? Talking about equity, what kind of market capitalization can they invest into, or do they do normally? What the kind of funds are available in the market right now?
Oh, it's a very wide variety. All different funds have their own approach. Some are, large and mid cap tilted. Mostly, it's anchored around large and mid cap, but there are funds which have a very significant allocation to small caps as well. And that is where we see that they are the outliers. They are the ones which are actually, the most rewarding in recent times.
How can a fund manager actually mitigate your risk and also, just get you away from the entire fear of volatility through a from a multi-asset allocation strategy?
No, these funds are, these funds have a utility. These funds have a utility for anybody who is going to start in mutual fund for the first time. It is a steadier take on growth. And once you invest in such a fund, these funds will not.
I think there is some audio issue happening. Yeah. Dhirendra sir, can you hear me?
Yeah.
Yeah.
Yes, I can hear you.
Please continue. Yeah, please continue.
Yeah, these funds are meant for the naive new investors in mutual fund who are looking at long-term investment vehicle, but a relatively steadier one. Because when investors chase performance, till yesterday they would have liked the small cap, but today they will dislike it simply because it has gone down so freely. So these funds help you get used to mutual fund and get used to acclimatize yourself with the equity behavior very, very nicely. So these funds are just meant for those investors. As you mature, as you get older with your investments, you have built your portfolio, you have a couple of equity fund, couple of fixed income fund, you start arriving at what is right for you, what you're comfortable with, then you have to really take charge of your allocation. And it can change quite dramatically depending on your needs. But these funds are useful for anybody who in his first couple of years of beginning his investments. These are very useful vehicle for somebody to fall in habit of investments.
Any particular type of category under hybrid that you might want to compare this fund with?
I would say that, aggressive hybrid is one such category because, these funds, we are just looking at the bright side of it. There could be a situation because gold is not a secular, is not a allocation which will rise. We haven't seen a phase. There has been phases when gold has given you a very equity kind of decline. And that is when these funds can also disappoint you. They can just nullify all the equity gains in a year or all the fixed income gains in a year. So wait for that. I would say that investor has to get used to the aggressive hybrid category or the conservative hybrid category because they are the meaningful allocation. They are very well defined. They rebalance themselves, and there the investors have the great advantage that you don't incur the cost or the tax of rebalancing. If I carry a portfolio of 75% equity and 25% debt, and if I rebalance it every year, my gains will get reduced by 10% to the extent I am able to realize the gain. When you invest in an aggressive hybrid fund, you don't have to worry about it. You are not liable to pay any taxes till you realize your investments. So it could well be a long-term investment, and if you carefully choose one, it could be many, many years. Likewise, so mutual fund is a very effective vehicle for tax deferral. You are not liable to pay taxes even though the fund manager is acting every day.
One last question on the multi-asset allocation fund that I want to ask you, because a few funds also have their exposure in real estate via REITs or InvITs. Now, this particular investment category in real estate is yet to pick up in India. How do you look at it? And do you think it's advisable to maybe have a separate allocation of REITs or InvITs? Maybe if you're looking at real estate exposure in your portfolio, that makes sense rather than having this exposure through a multi-asset allocation fund.
The mandate of these funds permit them to invest in them. Many other funds have also enabled in their offer document or revised their prospectus to invest there. But REIT and InvIT market has not evolved and has not gained maturity. Till recently, it was not even attractive to invest in them. Today, if they are investing there, it is just to just because their mandate says so, and they have they have tested the water. But I don't think one should look at it very, very seriously as an asset class because it has not emerged or not mature. But the way I look at InvITs and REITs is that it's an income yielding portfolio with a possibility of some gains over time.
That will be all. Lots to discuss, but then the time is actually up. Thank you so much, Dhirendra sir, for taking time out and explaining this category to our viewers today. Thank you. On that note, let's take a quick break, but then post that, let's talk about passive investment, and in that also this focus is on index fund. With me will be Suresh Sathagopal to talk more on this after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Low fees, passive management, diversification, low risk. Index funds offer you all of this, and with the AMCs or more the newly licensed AMCs filing for index funds, should you as an investor look towards this category, or is it just a trend that one should not be swayed away with? Let's decode all of this. I have Suresh Sathagopal, founder, Ladder 7 Financial Advisories with me. Suresh, good evening and welcome to The Money Show. All right, so a lot of index funds being launched, and mainly we were seeing investors replacing it with the active large cap funds. But then the overall advantage of having an index fund in your portfolio, placing it right, I think this has been discussed a lot of time now. The question in concern, or the question that's very trendy these days, is should you be buying an index fund with a new AMC that has just got a license, or maybe the existing ones?
See, I mean, an index fund is an index fund. Okay. So if you are going to actually, for example, launch an Nifty 50 fund, whether it is a newly launched fund house like Navi or Grow or any of those fund houses, or if it is an existing fund, if you ask me, there is not much of a difference. While saying that, yeah, there are things which you need to contend with. the experience in terms of managing an index fund has to be also given some credit and credence. However, as far as the performance is concerned, the only thing that you need to consider is you have to find out what is the kind of tracking error that is there. And as far as the tracking error is concerned, if somebody has a track record, it is better. So to that extent, if some fund house has a 3-year, 5-year track record, it is good to know that the tracking error is actually low. And the tracking error can happen, like we know, because of cash holding, because of expense ratio, because there could be a lag in terms of adjusting the underlying components of the index when it changes and things like that. So it can happen. So largely speaking, I would say I would not really not invest in a new fund. But at the same time, knowing something about the tracking error and the kind of performance they have been able to deliver, which is very close to the index performance, is actually good to know.
Mm-hmm. And also one thing, because we're talking about passive investment and we are focusing on the index-based strategy, can we have a sectoral approach index fund also in the portfolio, or that's something that you should really rely on the active way and the fund manager's expertise?
I would say probably if you are looking at an overall index like Nifty 50 or a Nifty 100 or Nifty 500, these kind of things, I think tracking the index will be a great idea. But if you really want, let us say, a IT index, I would probably not go for an IT index. I mean, there are two kinds of people who are going to be there. There are going to be people who are looking at certain good counters in IT, for example. I'm just giving that as an example. And they may want to allow the fund manager to pick up the appropriate stocks and put together a portfolio for them. So an active fund will be better. For other people who really are taken in by a particular sector, they feel that particular sector will do very well. It may be IT, pharma, banking. It can be any sector. So they want to put money, but they want to diversify their investment. If that is their motive with which they are looking at a particular sector, then they can actually look at an index fund. So slightly different motives and slightly different choices of funds.
What is the low cost benefit that we talk about usually when it comes to index based funds or passive strategies?
So in the case of any passive strategy, what happens is the fund manager and the team, they may not have to do too much work on which fund to which equity to pick out. Whereas they just have to focus on picking out and having the same underlying equity in the same proportion as it is in the index. So basically they will need to mimic the index without any lag. So because of that, the fund manager component in terms of managing an index fund actually comes down. The fund manager risk actually really comes down. So if you look at it from that point of view, then the fund manager, whatever expense ratio they normally take from the fund management point of view dramatically comes down, and it is true across most of the index funds. So if you really are looking at participating in a particular index, which may be Nifty 50 or Nifty 100 or Nifty 500, it may be a very good idea to go for an index fund as compared to, let us say, an actively managed fund. And especially if you are looking at the large cap oriented funds, if you look at the SPIVA report, the S&P active versus index, at least in the large cap category, there is a very clear case of going for the index, because more than 65% of the funds have not been able to outperform the index. So that is the story. As far as the mid and small cap is concerned, I think there is still a lot of stock picking expertise which can help investors. So large cap, I would say index funds definitely are going to outperform, and mid and small cap active funds may be a good choice.
Mm-hmm. All right, so that's the passive strategy one can have in their portfolio. But then it's also important to balance it out in a right way, right, in your portfolio, because even though you have maybe a large cap index fund in your portfolio, but then you also have a flexi cap, and a lot of flexi cap we know are having are large cap biased. How do you balance this out actually? How do you ensure that you are not over diversified in one particular market cap?
financial advisor, normally what we do is we do an asset allocation within the overall asset categories like equity, debt, gold, real estate, and others. Within equity, typically we would say we will choose so much of large cap, so much of mid cap, so much of small cap, and so on and so forth. So in our case, we can actually hope to choose one large cap fund, which may be a passive fund, maybe one mid cap fund, one small cap fund, which may be active funds. So that kind of a thing can be done. But if I really do not want to do that and I want to go the multi-cap or flexi-cap way, where I allow the fund managers to do that job, see, that is another kind of strategy, and I would not say it's a bad strategy. The only thing is, if I'm actually taking care of the fund's portfolio and I'm actively managing that by way of the various mutual funds or other components, I can very well do that by simply going for the label, that is large cap or a mid cap or a small cap, and I can actually put together the appropriate mix and I can manage that. But for people who are not able to do that, then they can go for flexi cap or multi cap and things like that. Yes, you are absolutely right. There is a limitation there. You don't know how much of small cap may be there or how much of mid cap may be there in a flexi cap. It is going to be the fund manager's choice. You don't have too much say in that thing. So with that limitation, I think still it is a good bet for a lot of people who want to invest in equity and participate in mid cap and small cap, because a lot of people are very afraid of mid and small caps also. Performance is good and a lot of people want to do that, but yeah, I mean, it's a scary space.
All right. I think a lot of aspects that we've covered as far as investing in index funds are concerned. Thank you so much, Suresh, for taking time out and advising our investors taking the right step ahead. Thank you.
Thank you, Kavita.
All right, on that note, let's take a quick break, but then post that, we'll be joined by Gautam Kalia, who will be answering your mutual fund portfolio related queries. And if in case you want to ask a question or you want help from our experts to plan your financial goals, you can send us your queries on our WhatsApp number, which is flashed on your screen, and also an email ID where we keep waiting for your questions. Send us your latest investments, maybe mutual fund, insurance, whatever you have, if at all you want any typical financial goal related solution from our experts. The WhatsApp number is 8657974571 and the email ID is themoneyshow@etnow.tv. More on this after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and last part of the show where there are plethora of funds available in the market, and where should you invest your hard-earned money in? How do you assess which is the right fund for your portfolio, and what are the criteria that one should look at, and how can you have a fund in your portfolio that's aligned with your financial goals? Now, to help you navigate through this maze, we have Gautam Kalia, Senior Vice President and Head Super Investor at Sharekhan by BNP Paribas, to answer all of your questions, and also do not forget to send us your portfolio queries on our WhatsApp number, which is 865-797-4571. You can also email us your query on themoneyshow@etnow.tv. So that's the place where you can reach us and have your live financial planning through our experts. But then, Gautam, good evening and welcome to the show. And I have our first viewer online with me, Ajab from Goa. Ajab, hi, good evening. How are you doing today?
I'm good, madam. Thanks.
Thank you so much, Ajab, for sending us your question. The funds that I can see are ICICI Pru Large and Mid Cap, Nippon India Small Cap, Nippon India Mid Cap, Quant Small Cap, Parag Parikh Flexi Cap, Motilal Oswal Mid Cap, SBI Mid Cap, and Quant Active. The time horizon is almost 10 to 12 years, and you want to have a corpus, but you are not sure as to what's the amount that you would be needing at the age of 65, right?
Yes, ma'am.
So all these are lump sum investments? 5 lakhs each?
Yeah. Lump sum.
Okay.
Not lump sum exactly, but STP.
Okay, sure. So that's it, right? Nothing more than this that's going in these funds?
No, madam. Nothing.
Okay. Got it. Any specific reason why do you need this money at the age of 65? Is this going to be your only income?
No, just to better my future. That's it. for the retirement age. Nothing else. Nothing in specific.
All right. All right. Okay, nothing specific. So this is not
Yeah.
a portfolio from where you will need a regular income, every month
No,
income.
not at all, madam. No.
Perfect. That's a very important question that I wanted to ask you. All right, Gautam, anything else you want to ask Ajab?
Right, Ajab, so just wanted to say that you, in your query, you said that your investment horizon is 10, 12 years, but you're
Sure.
looking at from age 65. So are you looking to see whether it will reach a certain amount at age 60 also? Or?
I can wait till 65. Nothing.
Okay, okay, understood. So just wanted to tell you that your existing investment value of around 40 lakhs, if you keep it invested for the next 12 to 15 years, and it grows at 12%, then you're looking at somewhere around 1.6, 1.7 crores as corpus over the next 12 to 15 years. Now, when I looked at your portfolio, the portfolio is a little bit skewed on the small and mid cap side. So one can understand because of the, let's say, recent rally that there is a tendency to do that, but you're creating a 10, 15 year long portfolio. So you want to make it, ready for all ups and downs in the market and ready for a 10, 15 year horizon. So that's why maybe you need to reduce your exposure to small and mid cap space. So just in terms of scheme selection, I would say that it is continue with ICICI Prudential Large and Mid. You can move a couple of funds into Kotak Blue Chip funds that will increase your blue chip exposure. So the funds that I would suggest you move are Nippon India Growth Fund and Motilal Oswal Mid Cap. So both these are mid cap funds. These you can move to Kotak Blue Chip Fund. SBI Mid Cap, please continue. Nippon India Small Cap, you can move again to Parag Parikh Flexi Cap. Maybe 50% of this move to the Parag Parikh Flexi Cap, so that way you keep some exposure to small cap through this fund. Otherwise, you got quant small cap, which you continue, Parag Parikh Flexi Cap, which you continue, obviously just add a little bit more from the Nippon India Small, and quant active also you continue. So otherwise, in terms of scheme, no other changes.
Ajab, is there anything else that you want to ask Gautam?
No, nothing. That's it.
Thank you so much for sending us your question. We move on, and Gautam, I will take the next question of Mr. R. Reddy. And is it appropriate at this juncture to invest in Motilal Oswal Microcap 250 Index Fund? And he's very impressed by the kind of NAV growth in the last 2 months in this fund. So first of all, a small explainer on the micro cap category that you might want to give to our viewers, and a word of caution also along with that. And then we'll come to the query.
Right. So, I can understand why the query is coming, because like small and mid cap that are doing well, micro cap has been exceptionally well. So when there's a very large, a lot of liquidity entering the market, then you have all sorts of hot money coming in, and it's not just foreign institutional investors, domestic investors. It's a lot of new investors, people who are operating on tips. People who are talking to their friends who are not really doing due diligence and investing, because anything you invest in is making money. So as a result, there's some companies that are very, very small. So they're smaller than small cap, and that come under the micro cap space. And there's a lot of liquidity chasing this, and there's a lot of, let's say, ambition in terms of expectation of business performance and share price, and maybe a lot of greed also chasing. So the last couple of months, obviously, we see 20% return in that segment. But my suggestion would be that if you want to expose yourself and you want to invest there, then obviously look at it from at least an 8-year time horizon. And invest again in a staggered manner, especially given that the market is running up very quickly and valuations are becoming more and more expensive. In fact, there is a recent note from a brokerage house also that talks about how they are finding not enough attractive names right now to suggest to their clients in the small and mid cap space. And that's in the small and mid cap space. Here we are talking about micro caps, which is tougher. And there still are, a lot of companies which have corporate governance issues. There are other issues that don't show up, and information is not completely available 24/7 or easily accessible. So that's why it becomes much more riskier for you to look at something like this. So if you are interested in doing it, please go ahead, but keep in mind an 8-year horizon. Invest in a staggered manner and a small allocation